Aloha Friday, high five Team Ohana. I wanted to give you guys a quick update on some changes that were announced this week by Fannie Mae. Now, Fannie Mae is the mortgage-backed security, one of the mortgage-backed securities that sets loan level pricing adjustments on conventional loans and also sets guidelines on conventional loans. Now, Freddie Mac has not made an announcement yet, but typically they follow Fannie Mae to the letter. So we're expecting their response here very shortly. The change that we're looking at is Fannie Mae has said that they are going to change the LLPAs, the loan level pricing adjustments on loans, starting in May. So banks are going to start adjusting for this in their pricing probably within the next 30 days. Now, what's a loan level pricing adjustment? The loan level pricing adjustment is a adjuster to the cost of the interest rate before the banks ever touch it. So this is what the banks are allowed to sell, and then of course they put their margins on top of it. What we see here is a color gradient of changes. So we've highlighted the rates that got better in green and the rates that got worse in red. Now, if you're a math major or economics major, or you are used to looking at money, this graph might seem weird to you. The pricing improved in the areas that we would expect pricing to get worse. Lower credit, lower down payment, riskier loans are getting better pricing, while higher credit and higher down payment, more secure loans are getting worse pricing. Why would the government do that? Well, Fannie Mae is taking the stance, as we saw last year with second homes and investment properties, that they do not want to encourage responsible ownership and responsible buyers. They want to encourage the single family, the primary residence, and now they want to encourage affordable housing. It's a good thing for people with lower credit and with less money down. However, I don't think it's a great thing that they're robbing from Peter to pay Paul. They're taking money, they're making it worse for responsible borrowers in order to pay for the improvements on the lower FICO and lower down payment borrowers. And I'm not necessarily sure that that's the best route to go, but this is what they've chosen to do. To give you an idea of what this graph is saying, so on a $500,000 loan, a 1/8% is about $1,250. 1% would be $5,000, an eighth of that, $1,250. So we're seeing almost a 3/4 of a point hit on the borrowers that are between a 720 and a 760 FICO, putting 20% down. That's a pretty substantial adjustment when you take into account that's probably your one of your more responsible borrower pools as far as volume. The majority of borrowers that have savings and have kept their credit up are going to be right here, right in this heat map, getting the worst pricing adjustment we've seen in the past few years. So this is coming out. Banks are going to start building this into their pricing. Again, this is conventional loans. But banks are going to start building this into their pricing within the next 30 to 45 days. So get in touch with your loan officer. Make sure you're having conversations early about how best to structure your loan, how best to get your credit in order, so that even after these adjustments, you can get a better interest rate, lower fees and costs, and have a better opportunity to have more options when you go to buy. If you guys have any questions, drop a comment below. If you like this content, I am trying to make more of it, so please follow, and we will be back next week. Have a great day, guys. Aloha.